It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast. Yes, as we look at the bigger picture, the bigger property picture around Australia, connecting the dots between the local market and this global shock, which is making waves right around the world. And it's another Saturday morning property show, your home base for real estate clarity. And if you are hitting the pavement for inspections today, I hope that you find the one. You know, that dream property at the dream price. And just as importantly, you can close it out. It is a Saturday, the 9th of May. If you're blowing out the candles today, many happy returns. Billy Joel, he's celebrating 77 years on the planet. Candice Bergen, do you know who she is? Murphy Brown out of, the 1990s? She's got a big number today. She's turning 80. Grant Hackett, local boy, Australian Olympic swimmer. He is turning 46. And I see that it was on this day back in 1988 that Queen Elizabeth officially opens the new Parliament House in Canberra. Were you there? I wonder if we've got anybody listening that was there on that day back in 1988. And on this day in 2020, during the height of the pandemic, the US unemployment rate hit 15%. Ouch. That is the highest since the Great Depression, and they are experiencing plenty of pain right now as we take you on our Saturday morning to Melbourne to catch up with Gareth Spense, the head of the Australian Economics for NAB. Welcome, Gareth, onto the Real Estate Breakfast this morning. That's pretty interesting, eh? Back in 2020 in the US with that unemployment rate hitting 15%, plenty of pain, around different parts of the world, but they've got pain, more pain to come probably.
Hi, Craig. Yeah, thanks for having me on. And I think, to highlight, as you note there, certainly a very volatile and uncertain world, particularly in our jobs as economists at the moment.
It's been a really busy week. What a week it's been, because the RBA decided to hike, yes, the cash rate up 25 basis points. I want to ask you this. Is it the end of this wait and see from the RBA? Because with inflationary pressures rebuilding, largely due to the rising oil prices and the global conflict, the luxury of waiting has probably vanished because we've got more rate increases in June, more than likely.
That's right. We've certainly seen those 3 back-to-back increases over the last 3 months, and that's taken us back to that previous peak in the cash rate of 4.35%. We actually changed our view this week, following the outcome from the RBA. We added an extra increase or another hike into our forecast profile. So we expect, as you say, an increase to 4.6% in June, is a reaction to building pressures in the economy that we saw largely through the second half of 2025 of higher inflation and pass-through, not just from, the direct impact of petrol prices, but, how does this flow through into transport costs and broader grocery prices and even construction prices? So the RBA is certainly watching pretty closely. And, we think normally you could sit around and wait and see what happens, certainly after 2 or 3 increases. But I guess giving the starting point has probably kept the pressure on the RBA a little bit.
Yeah, those fuel costs, man, they're the primary driver behind that latest quarterly figure of that staggering 32.8% jump in March alone. If the oil prices remain volatile, Gareth, how much can the RBA realistically do to offset global factors through domestic interest rates, do you think?
That's right. So I think, the RBA themselves would probably tell you that they can't do much. We don't have much impact on that price through our production or our consumption, for that matter, of oil or petrol and other refined products. With inflation now tracking back up, as you note, up near 5% in Q2, we expect on the headline measure largely due to those petrol prices. But in an underlying sense, when we strip out, even the volatile petrol prices, inflation is tracking somewhere closer to 3.5%, and we think we'll get kind of close to 4%, which is is, clearly too high and above targets. For the RBA, they certainly will look through the headline impact of those petrol prices, but really what they're concerned about here is those petrol prices then feed back into transport costs, and then that gets passed through to groceries, and then consumers, and we all become a little bit more accepting there of inflation, and it becomes a little bit more normalised in the economy. So the RBA, really wants to anchor those expectations. It is unclear. This shock is a little bit different to kind of previous shocks. We think that because oil prices are just so visible and so front of mind for households and certainly corporates and businesses, that there's a risk here that this pass-through, what we call second round impacts, so not just the headline price, but what does it do to other prices, will, pretty broadly spread and also certainly pass through possibly a little bit more quickly than what we've seen. And indeed, our NAB business survey for March already showed a very large spike in what businesses tell us is happening with their purchase costs as well.
Yeah, because the cash rate, it has returned to these levels seen back in December of 2024. That is mirroring the pre-pandemic environment of late 2011. So this move effectively, it wipes out the interest rate relief delivered to households last year, which is why I've kind of been banging on that this year feels completely different to last year. And given that we are back at those 2011 levels, how does the current resilience of the labour market change the impact of this rate?
That's a good point. We hadn't seen rates certainly this high for almost a decade. I think, we don't think, or we never thought rates would go back quite as low as they were in the lead up to the pandemic or even the depths of the pandemic. I think we certainly didn't expect this time last year that we'd be heading back up to 435 as the RBA began cutting. But I think, the key point here and really what matters a lot for going forward is what happens in that labour market. Despite all the uncertainty that we've seen over the last year, the labour market has been quite resilient. Employment growth is still tracking at about 30,000 a month, and that's certainly enough to keep that unemployment rate quite low at 4.25%. But the flip side for them is really watching what happens in the labour market and growth as well, because we know that if that unemployment rate does pick up, the focus will then shift a little bit away from the inflation mandate, a little bit more back towards, the labour market. And because ultimately what happens here is if that unemployment rate rises very quickly and very sharply, we'll actually know that there'll be some inflation pressure taken out of the economy. The RBA does target both inflation and, assesses where the unemployment rate is likely to go. And so, if that does show a big weakening in the economy, the balance or the choice will become, I guess, even a little bit more difficult for them, given they still need to make sure inflation does head back towards that 2.5%, kind of ensuring that growth does track near its potential.
We are talking to Gareth in Melbourne on the Saturday Morning Property Show. In a moment, we'll look at Sydney and Melbourne property markets, and can the RBA get into a holding pattern with rates? That is next.
From the emotion of property, the economic inflation, managing your expectations, lack of stock, price growth, construction appetite, days on the market. Stay informed with us and know your property. You're listening to the Saturday Property Market Update.
Hey, I want to take you back to the 1980s. In particular, 1980, the median house price in Sydney was roughly 77 grand. Now, while that sounds like a dream property today, the late 1980s, specifically 1989, saw standard variable mortgage interest rates peak at a staggering 17 to 18%. Now, for many homeowners at the time, the struggle wasn't the deposit gap, it was the repayment trap. Sound familiar in 2026? Now, this decade also sparked the great gentrification of inner city suburbs like Melbourne's Fitzroy and Sydney's Paddington, which transitioned from blue-collar worker hubs to the million-dollar enclaves that they are today. It is a Real Estate Saturday. Gareth is here from the NAB. And while the broader economy shows resilience, the housing sector is showing visible strain. I think that's pretty obvious to see. Sydney and Melbourne are experiencing steeper price falls while growth elsewhere is softening. Gareth, do you think the price falls in Sydney and Melbourne are a necessary cooling, or do they signal a more concerning downturn for 2026?
I think, it's quite interesting what we're seeing. I think Sydney and Melbourne probably are the two cities most exposed and most sensitive to interest rates. And, as you've noted, when we look back 6 months ago where we thought interest rates would be heading lower, they've actually reversed and gone up. And we're talking here about the risk of a bit more. So for Sydney, the price level there and certainly affordability constraints does come through kind of quite quickly. And so I'm not so surprised that we've seen a bit of an easing in Sydney. We know that, when house prices do kind of fall on most measures we look at, it does persist for a little while, and it has accelerated kind of over the last couple of months. So annualizing, at around a 6% annualized rate in Sydney declines over the last 3 months. That is kind of notable. With Melbourne, I think interesting that prices have been a little bit softer over time, certainly in the city where I am over the last few years. I think the irony there a little bit is that actually Melbourne and Victoria as a whole has done a little bit better on the supply side. So the expectation of higher interest rates, in my mind, will drive, a cycle in house prices. And I think we've seen this globally. We've seen it happen in New Zealand. We've seen it happen in Canada. The forces in Australia have been a little bit different. I think, ultimately population growth in Australia does remain still relatively solid, and the housing market in a fundamental sense kind of well undersupplied. So, but going forward, over time, certainly the property market just supported quite by that imbalance by supply and demand.
Yeah, because there is this strong desire for this period of stability following the hike this week, and a holding rate would allow the RBA to observe the actual impact of this new level on economic activity and consumer sentiment, which is waning. Avoiding back-to-back increases could be vital for maintaining what remains of consumer confidence. The RBA has moved to a holding pattern. What specific indicators do you think will they be watching most closely to signal their next move? I know that's kind of looking into the wishful thinking sphere.
It's interesting. They'll obviously be watching everything. I think, at a period like this where things are very uncertain, right? So we've got this huge amount of global uncertainty and geopolitical risk, and, none of us really knows when the Strait will open and oil prices will normalize. I think most people don't think that they'll actually go back to where they were pre this escalation in the conflict at all, but I think eventually they may. I think for the RBA, watching quite a few things, the interesting thing for the RBA in really assessing the stance of policy and where interest rates were late last year, actually what was happening in the housing markets. We know credit growth had been quite strong. House price growth had been pretty solid. And so the RBA will really try to be a little bit more forward-looking here, certainly looking at, kind of consumer spending data. You mentioned the confidence there. It certainly fell quite sharply on both the consumer and the business confidence measures in the last month. But I think really watching how that translates into broader activity is the key point. So what happens to actual consumer spending? We can kind of track that through our bank transactions data and some nifty data from the ABS as well these days that we didn't used to have, and certainly watching that labour market as well. The labour market has been quite resilient. It's tracked at that 4.25 for quite a while now, and that will help the RBA look forward at least a little bit. I certainly agree with the sentiment there that the RBA at some point will wait and see. Let's see how that goes, and I think the challenge for the RBA is going to be really weighing up that balance here between what happens to inflation and how quickly they expect that to come back.
Plenty of good takeaways from many of your points. Thanks for coming on to the Real Estate Saturday Morning Property Show. Enjoy the weekend that has landed. And yes, talk again in the future.
Thank you very much. Look forward to it.
Explore new property destinations where you could live with exclusive interviews covering real estate news and market insights.
Perth's annual growth, 194,000 in the housing market. That is up 21.5%.
Yeah, and it was trending even faster in terms of the rate of growth over the first quarter of this year. I think it was 7.6% over the quarter. That's equating to about 30% per annum. I don't think it'll keep running at that rate.
also talk about the fact that you are mainly buying in Melbourne and Geelong.
We are, yeah. There's a handful of middle ring suburbs we're hitting pretty hard at the moment in Melbourne, and I'm very bullish on Geelong as well, especially for clients that are a little bit more yield sensitive. I think that that's where the best capital growth outcomes will be over the next 3, 4, 5 years, despite the fact that Perth's obviously going to outperform Victoria this year.
We connect you to the best real estate information across Australia. The Real Estate Podcast.